We were lucky enough to close our fundraise before the demonetization, and I know a couple of friends who had started the fundraise and well into the fundraise when the demonetization happened. Some of that fundraise got delayed. We were lucky enough to close it before that. But having said that, our strategy has been to de-risk in terms of geography, have a flexible investment strategy. So when we say that a particular market is affected for a short term, it does not mean either investment or fundraise or exits come to a halt. The way we've looked at it is we are a fund that invests across 3 geographies. So when we are investing in 3 geographies, we make sure that there is enough counterbalance across all 3 markets to be able to de-risk the entire fund. So that's how the entire investment philosophy is. So yes, demonetization has been a short-term market depressing scenario for us in India, but there has been absolutely no impact on the other portfolios. Always been bullish on financials. We continue to be bullish, and our track record and our efforts have been very, very significant in the financial side. Now, technology we have always considered to be as an enabler of financial services. The popular term fintech constitutes that it's not an enabler but a business in itself. Now, I have a little bit of apprehension in that space because it's a space that is subject to huge amounts of disruption in a short term. Now, in as short time frame as 3 months and 6 months, there's a lot of disruption that keeps happening. So this brings a new set of management challenges, both for the team as well as from a fund point of view. I'm not sure as an advisor we are equipped to kind of deal with some of those very rapidly evolving challenges. For example, post demonetization, you saw debit card, credit card transactions zoom up. But then what we hear is that in January and February they've come back a little bit. It's still higher than October, but it's still come back. Now, how do you do long-term projections based on this? You can't do it. Several sectors in the healthcare stroke pharma space, and we've looked at hospitals, we've looked at healthcare delivery services, we've looked at pharma, and we thought at that point of time the domestic pharma segment made a lot of sense, and that's a segment that we think has created value in the past and will continue to create value in future. So that's a segment that we think that is a go-to segment for now. If you see the hospital segment, which has seen a lot of activity in the last 1 year, there's a lot of investor interest. What we are seeing is the break-even points are getting increasingly elongated. Now, earlier used to be a 3-year, 4-year, 5-year kind of, now it's become 7, 8, 9-year kind of a horizon. Obviously, funds invest with a horizon of about 5, 6 years. Now, if you are doing a greenfield project today and if it breaks even in 7 years, obviously your ROEs are going to be depressed for 6, 7, 8 years. That's a cause of concern for us. We have stayed away from very asset-heavy sectors, the infrastructure sectors. We've stayed away from early stage. We have stayed away from cyclicals, B2B businesses, pure B2B businesses, for example, an OEM-based auto component. So these are sectors that we've stayed away, which I think has been a good strategy. We would continue to stay away from that. But apart from that, we would continue to be a sector-agnostic fund. What you're saying is true for us in India. That's what we've done. But if you see the fund dispersion is about 40 listed and 60 unlisted, 60 private. So the fund is pretty much flexible in terms of where it wants to invest. But in India, what we have done is we have found the opportunities in listed space much more attractive, and we have been proved right. We've had 3 full exits at this point of time, and the fund has generated on a weighted average basis across the 3 investments a return of roughly about in the range of about 3x in dollar terms. So that's where roughly it is today. And as far as the pipeline is concerned, I think we would look at least another 2 to 3 exits in a 12 to 14 month time frame. India and Indonesia are somewhat similar, but to put it very loosely, what we like to say is Indonesia is probably 10 years behind or 5 years behind India in terms of PE adoption, not in terms of investor savviness or not those kind of things, but in terms of PE adoption. For example, what India went through in the early 2000s is what probably Indonesia is going through today. Malaysia is slightly different. It's a mature market, more mature market. You don't expect the growth that you see in India or Indonesia to be seen in Malaysia. But the kind of deals that we do, that the fund does in Malaysia, are where there are a lot of first generation entrepreneurs who have become, say, 65, 70 years old, and they don't want to run the business forever. And they've also reached a plateau in terms of management capability. They don't have any succession because neither their relatives or their kids want to come in and run the business. So we see this as a good opportunity. Get in good management from outside, buy a stake from the existing promoters, run this business for 3, 4, 5 years, and then sell it to a strategic. So I think this is a good model that works in Malaysia. So what we've done is in the fund, as far as the third fund is concerned, it has also added Philippines and Sri Lanka. Its challenges are always there. I don't think it is any different in terms of where the valuations are headed or what kind of return. For example, if you have, let's say, a very low valuation, it also comes with attendant risks in terms of lower return potential. So there's always a trade-off. So it's not very straightforward. But I would say on a risk-adjusted basis, valuations are pretty much similar.